Corporate Finance Practice Problem using Excel. Calculate bond after-tax cost to issue. Get ready, it's time to take your chance with Corporate Finance. Here we are in our Excel worksheet. If you have access to the Excel worksheet and would like to follow along, note that we are in the Practice tab as opposed to the Example tab. The Example tab in essence being an answer key. Information is going to be on the left-hand side. We will populate that information into the blue area on the right-hand side. We're looking for the after-tax cost of the issuance of the bond, a form of debt. We want to represent that on a percentage basis. Note we have a similar problem with any kind of debt as opposed to like equity, debt and equity, the two ways to finance debt financing, issuance of bond on the corporate side of things. And that will be that there's going to be a tax consequent on it as well, because the cost of the bond, the interest that we have to pay on the bond, will typically be deductible, which is actually good for taxes. Therefore, the cost is not simply on a percentage basis, the percent of interest, but it's going to have to be adjusted for the tax benefit that will be involved as well. Bonds are also a little bit more complicated in that we have two rates that we're talking about. We're talking about the rate of interest that will be paid on the bond, and we also then have the rate that is the market rate that we have to consider. Those two things possibly not being the same. If they're not the same, then the bond will generally have been issued at either a premium or a discount in order to issue the bond. So then the question is, well, what rate do we use when we're trying to figure out the cost on a percentage basis? And the answer is typically going to be the market rate. And that might sound a little bit unusual because you're saying, hey, look, the interest that we're actually paying is going to be based on basically the rate on the bond. And in this case, we don't have the rate, we just have the payments, which we're saying are $90. That's different than the market rate. But basically what happens, and if you think about it from like an accounting type of standpoint, when you issue the bond at a premium or a discount, you then have to amortize the premium or discount, and typically that will result in the other side going to interest expense. So ultimately, you kind of are using the market rate if you sell it as a premium or a discount, and so that's why that would be a good estimate in order to use rather than the rate on the bond, even though the actual payments you're making once you get going are going to be on the rate on the bond. The difference between the premium and the discount and the rate and the face amount of the bond is basically due to interest. So let's see that a little bit more clearly here. We have our information on the bond outstanding. We're saying had a par value of 1,000. The year to maturity is going to be 25. Annual interest payment we're going to say is 90. So we don't have the rate given here. We just said the payment is going to be 90. And then the current market price we're saying is 930. So you can see this being issued then at a discount. Down below will work basically the same situation, but this one being issued basically at a premium. So this one's going to be issued at a discount. We know the tax rate is going to be the 35%. So now we want to figure out basically what's the percent cost after taxes. This one's been a little bit more complex in that we don't know the market rate. We got to figure out the market rate first. If they had given us the market rate, then we could do a calculation similar to that we had seen in the past. If we're not given the market rate, in this case, we're given the price and we have to back into the market rate, we've got to first do something we've seen with the bonds in our bond section. So we've done more problems on this on basically when we thought about bonds to figure out what the market rate would be based on the price. Then we're going to take that market rate as opposed to the rate on the bond to help us to then figure out what the cost of the debt after tax would be. So if we're trying to figure out the market rate, there's a couple ways we can do it. I think the more intuitive way would be to figure out the price here. Normally would be to take the annuity and then add the present value of 1, the annuity of present valuing the annuity payments, the interest payments, present valuing the end payment of 1 at the end of the bond, adding those two up, and then using basically goal seek to figure out what the actual rate is. Or we can use the rate function. Even if you use the rate function, however, I would still double check it basically with this first method here. So let's first use the goal seek method. I think this is the most intuitive method. It's difficult to do this mathematically because basically we have two things going on, an annuity and a present value of 1 calculation. So algebraically it gets a little bit complex. Obviously with Excel, it's a lot easier to kind of to work out. So in any case, let's just imagine that the rate is going to be, let's say 5%, 0.05, and then use that to calculate the total down here, which would be the price, and then we'll adjust this using goal seek to figure the price at the 930. Then we'll do the same thing with the rate function. So let's use the present value calculation equals the present value shift 9. We're going to take the rate, which we're estimating to be that 5%, comma, number of periods. We're going to say 25. We're assuming it's an annual interest bond, comma, and then the payments that we're going to have are going to be the $90. $90 because they gave us the payment, not the interest rate. If they gave us the rate, we'd have to take the rate on the bond times the 1,000. That's going to give us, let's make that a positive number by going back into it. I'm going to put a negative sign before the P to make it a positive number. Let's do the present value of 1, present value in this 1,000 with our assumed rate of the 5%, negative present value, shift 9, rate is going to be that assumed 5%, comma, number of periods is going to be 25, comma, comma, future value, we're going to be picking up that 1,000 and enter. So if we add those two up, we get a price based on that 5% rate of the 1563.76. Now, we need it to be 930. I can then change this percent here to get closer and closer to what it should be. Right, we can go to 8 and so on and so forth. I can use GoalSeek to then do that for me. Go into the Data tab, go into the What If analysis, GoalSeek, and we want to set then this cell to be what we know it should be, that 930, which I have to hard code here, 930, by then changing the rate over here. And then we're going to say, okay, do that, please. And there it is. So the rate would be that 9.76. Now we can do that a little bit more easily with the rate function in Excel. I'll just type in the rate function. This time we got to be careful with negative numbers as we use the rate function, however. So I'm going to say this is going to be equal to the rate shift 9 and the number of periods. I'm going to pick up the 25, comma, the payment that we're looking for is going to be the 90. And I think that needs to be a negative 90. That's where the trickiness comes in, comma. If you don't put the proper negatives in, it won't give you the proper answer. And then the present value we're saying is the 930, comma, future value, I need a negative here, I believe, as well, of the 1,000 there. And that should do it for us. Enter. Notice it gets there a lot faster than doing this calculation. However, I would still double check this calculation by doing this present value of the annuity using that rate and the present value of 1 just to double check that you do indeed get to that 930 again. Once we have this amount, the 976, which is the market rate, because the market rate is what's going to determine what we have to issue the bond for, in this case at a discount, and that the difference between that discount is going to be basically, work itself out with interest payments as we then amortize the discount over the life of the bond. So we're not using the bond rate, which in this would be 90 divided by 1,000 or 9%. We are instead using the 9.76%, the market rate, even though when we pay the interest payments, we're paying the $90 due to the fact that the difference is really basically interest that we will record in the format of interest basically when we amortize the discount that we had to put in place when we basically sold the bonds for 930 and then have to pay at the end of the time period 1,000 at the end. Okay, so now we can just do our normal type of calculation now that we have the cost. This would normally be what we consider the cost to be if there were no taxes. Now we have to include taxes. So we're going to say, all right, so the interest rate, and I'm going to say market rate, is going to be then this 9.76, making that a percent, percentifying it, add a couple decimals. Then we're going to take the 1 minus, that's not a minus, tax rate, shift 9, colon, that's going to be 1, and then the tax rate. So I'm going to say tax rate is going to be then the 35% here, 35%. I'm going to percentify these two cells, number group, percentify them, underline here, font, and then underline, subtract those out. This is going to be the 100 minus the 35. Let's put that in the outer column. The 100 minus the 35, making that a percent, number group, percentifying it. And this is going to be a subtotal. And then let's indent these two while we're here. Alignment, indent this one, alignment, indent. And then down here, we're going to call this the cost of debt after tax, which is going to be equal to the 9.76 times the 65. And we're going to go to the numbers group, percentify that, add a couple decimals. We're looking 6.34. So this would be the market rate. This would be what we think the cost is after we take into consideration the tax impact. The 9%, 90 divided by the 1,000, would be the actual rate on the face of the bond. So it gets a little confusing there. Home tab, font group, underline. If we try to plug this into our longer, basically, example and think about what the actual calculation would be, it looks something like this, as we've seen in prior presentation. We can calculate the interest, which is basically market, using the market rate. Shift, and then this is where the confusion kind of lies here, because the interest you're saying would be the 1,000. The 1,000. Let's just call it the debt of 1,000 is going to be the face of the bond that would be owed at maturity, and then the interest rate would be market rate. And again, you would think, why isn't it 90 divided by 1,000, the rate on the bond? Why isn't it 9? Because even though we're paying $90, which is 9,000 times the rate on the bond, the difference between the two is going to be amortized out. So the real rate that we're paying, because we sold it at a discount, is the market rate. And that's the confusing component here. So we're going to say market rate, then it's what we have to use there. That would give us the interest. So we got the 1,000 times the market rate. And then I'm going to add a couple decimals, numbers, adding a couple decimals. Also note that when you're using that market rate, then it's a little confusing to tie it out to each period that is going to be covered, depending on how you amortize the discount or premium. In any case, let's leave it at that. We're going to then highlight these three. We're going to go to the Home tab, Alignment, Indent. Then we're going to go to the Alignment and Indent here. Again, the tax benefit, and this is going to be the interest expense. Let's call it expense deduction. So we can deduct the interest expense. That's going to be like the benefit here, which is going to be that 97.57, basically on average over the life of the bond. We're going to then say numbers per, let's make that a couple decimals. And then we're going to say the tax rate. Tax rate is going to be this 35%. Percentifying that, numbers group, percentify, underline, font group, underline. We're going to take then the 95.57 times that 35%, add a couple decimals, number group, decimalizing it. And then we're going to say that that is the tax benefit. And let's do some indentations here, selecting these three: alignment, indent, tax benefit, alignment, indent. So that's going to be that, and then we're going to have the cost of debt after taxes on a dollar basis is going to be, on average, the 97.57 minus the 34.15, adding some decimals, number group, couple decimals, underlining this one, font group, underline, and then we can take a look at the cost of debt after tax percent, calculating the cost of debt after taxes being that 63.42, comparing it to the debt face amount here that we have to pay at maturity, the 1,000, adding a couple decimals to the 63, numbers group, couple decimals, underlining, font group, and underline. And then this is going to be the cost of debt after tax percent. And this is going to be equal to the 63.42 divided by the 1,000, making that a percent, number group, percentifying it, adding a couple decimals. We get once again to that 6.34, 6.34. Let's indent here, alignment, indent. Indent this one, alignment, indent. Okay, let's do this again. We'll do it a bit quicker here. This time we had a discount situation here. Let's do the same thing where we have basically a premium type of situation. So note that the rate on the bond was 9% still, just as it was here, 90 divided by the 1,009%. Last time we came up to a market rate that was higher, resulting in it having to have been issued then at a discount. So this time we're expecting then it to be issued basically at a premium. It has been issued at a premium. So we expect then the market rate then to be lower than 9%. So let's do that calculation. Let's do the goal seek kind of component first. I'm just going to guess a number over here to start off, just like we did last time. 0.05 or 5%. We'll calculate based on that number and then use goal seek to adjust it. So I'm going to say, let's say this is the negative. Let's say negative present value, shift 9, the rate 5% that we're guessing right now, comma, number of periods is going to be then 25, comma, the payment is still going to be the 90, and enter. Now let's do the present value of this 1,000, negative present value, shift 9, rate is going to be, we're guessing that 5%, comma, number of periods 25, comma, because not an annuity, we're going to then pick up the future value, that 1,000. If we present value those two, adding these two up, we would get to 156376. We want to get to 1115, so we can adjust it by changing this number to get closer and closer, and use goal seek to simply do that for us. So let's use goal seek, data tab up top. We're going to go to the what if analysis in the forecast section. Goal seek. What's the goal that you seek, says Excel. We have a noble goal of seeking that this cell be this number 1115 by changing this cell. Could you help us seek that goal? And we'll say, okay. And Excel's like, yeah, it comes out to 7.93. Goal has been sought. Goal has been found. So, of course, that rate lower than the 9% as expected. Let's go ahead and do it here with the rate function this time. Rate function equals the rate shift 9. We have the number of periods, which is going to be the 25, comma. The payment is going to be 90, comma. The present value, we're going to say, is the 1115, comma. Future value is going to be the 1,000. However, we know that the future value needs to be negative, and the payment over here needs to be negative, or else the function doesn't work right, and it's annoying. So we're going to make negative there. So there we have it. Now this matches this up here. This is the easier way to do it, but even if done that way, I would double check it by doing your calculation annuity present value of 1 calculation. Once we have that market rate now, we can do our same calculation to then think about, well, what's the cost after tax? That's basically the cost before tax. What's going to be the cost after tax? So we're in a similar situation, just making sure that we're picking up the right number to be using here. We're going to take the interest rate, market rate, which is going to be what we just calculated, the 7.93, percentifying it, home tab, numbers group, percentify, adding a couple decimals. Then we're going to be picking up the 1 minus the tax rate and colon. And we'll have 1 and then the tax rate, which is going to be here, which is going to be the 35%. Let's make those two percentified. Numbers, percentify them. Underline the 35, font group, and underline. This is going to be a subtotal. And then we'll take the 100% minus the 35%, percentifying that number group, percentified. And then we're going to, let's indent these two for the fun of it. Alignment, indent. It's not just fun, it looks better. Subtotal, alignment, indent. And then we're going to call this the cost of debt after tax, which is going to be the 7.93 times the 65%. Percentifying it, numbers, percentify, adding a couple decimals, and underlining here, font group, and underline. So there we have it. Now let's kind of prove our calculation by doing it with our example over here, kind of a longer calculation, but I think it's one that ties it together a little bit easier. So we got the interest component. What's the interest calculation? Normally it would be the debt, which would be the face amount of the 1,000. And then we would multiply that times the interest rate, which this time is the market rate. This is the confusing component because you're not paying based on the market rate, but due to the fact that you had to issue it, in this case, at a premium, you will be amortizing that premium and basically hopefully expensing it, hopefully it being deductible and whatnot, and therefore that's why you use the market rate. So we're saying market rate then at the 7.93 as opposed to the 9%. which would be 90 divided by 1,000, or the rate on the bond. That's going to be the interest, and that's going to be equal to the 1,000 times that market rate. Adding a couple decimals, numbers, decimals, and then let's indent these. Go into the alignment, indent this one again, alignment and indent. Then we're going to go to the tax benefit. What's the tax benefit then of this? Well, we'll tell you. It's the interest expense deduction that you would get on average over the life of this thing, which would be the 79.29, adding some decimals, number group decimals, and then multiply times the tax rate, which I'll just say equals the tax rate over here, which is that 35%, and making that a percent, numbers group, percentifying it, font group, underlining it, and then multiplying that out, 79.29 times the 35%, adding pennies, numbers group, couple pennies. That's going to be the tax benefit. All right, then we'll go ahead and indent these two, or three, alignment, indent again. So then we can subtract those two out and give us the cost of debt after taxes on a dollar basis, which would be the 79.29 minus the 27.75, adding decimals, numbers group, couple decimals, underlining the 27, font group, underline. And then we can think about, well, what about on like a percentage basis? If I took the cost of debt after tax percent is what we want now. We could say, all right, well, then we'll just take the cost of debt after taxes here, which we just calculated on a dollar basis, adding decimals, number group, decimals, compare it to the debt itself, which was the 1,000 face amount of the bond that we have to pay at maturity. And that's going to give us the cost of debt after tax percent. And we'll just divide that out then. So that's what we'll do. The 5154 divided by the 1,000. And then we're going to go to the number group, make that a percent. And there we have it. Let's do some indentations here. Alignment, indent. Down here, alignment, indent. And there we have it at the 5.15.